Hi everyone, this is the 30th of September 2018. We've just completed the month, day, week, quarter and it's the third quarter for this year. And for the quarter itself, we've actually closed positive on the index. However, for the month, we've closed meaningfully down, creating what is known as an engulfing bear candlestick on the monthly chart. Now, often I've mentioned about candle when it comes to candlestick patterns. Then these patterns gain their significance at points where it matches a good Elliott wave structure, but or also other technical readings. For example, if you are at an important resistance, if you are at an important Fibonacci level, you could be at the Bollinger Bands and so on. So where you are in the structure and level along with the candlestick pattern itself gives it its importance. Otherwise, sometimes there are patterns that have lower significance. But that too, when I say significance, it's really about most people are really looking for major turning points when it comes to the use of candlestick patterns, whereas the patterns themselves were developed, I think, more as looking for immediate trade setups, and in that sense, they do often give you good points of support resistance to deal with on an immediate basis, above or beyond which an important trend could result. And so that said, we've also seen the rollover of momentum on the monthly charts on the Nifty and Sensex this month. Again, they've been whipsawing from sell to buy and back into sell mode. And those are reasons to, and that this time after a negative divergence. So those are reasons to actually get into that debate, which I tried to put my historical perspective to yesterday, which is, are we in a bear market? And it's an interesting question to raise, especially after the market has actually fallen for 4 consecutive weeks on the Nifty, and has had a much sharper fall, in fact, in these small cap and bank Nifty, which have fallen equally in size to what they had done in Feb and March. And so those declines have actually been far more sharper, which is why people are probably willing to get into that debate. But somewhere, I found that a lot of people are still equating bull and bearish cycles with percentage readings, things like okay, if it's down 20%, then it's a bear market. And so I really wanted to push that debate back in terms of that these definitions are actually meaningless, because by the time you're down 20%, calling it a bear market has no meaning because what are you going to do with that interpretation? If it's only to put it in a textbook, then fine. But if you really want to trade after it's fallen 20%, then probably it could be meaningless, especially if it's a 1 year decline, which is what I wanted to show, that most corrections, in fact, not even 1 year, many of the corrections which were like 3-4 months long also, or 6 months long during the 2001 to 2008 period, were within the 25 to 30% range. So what you're really then looking for is being able to take that bigger call, and that you can only do by looking at the Elliott wave structure of the market, and then understanding the economic cycles, which is why I've extended the study to put together economic cycles with the Elliott wave reading, and also similarly when I look at stocks longer term, to put the business cycle of that particular stock in terms of where it is on its growth valuation perspective with what the Elliott wave reading is. And I've put those charts, I think, online. They are free to see and learn and get an idea of what the model is, and that's what I use to take my views and opinions on the market, and they've always helped me in terms of having the bigger perspective right so far. And the current phase, of course, has been extended in time, but because I put 2 and 2 together, I have not really found evidence that allows me to back off on my view as yet, because the economic data continues to fit into what I have been talking about. So that said, it's a good historical perspective. If you have not really read the post, I've put it on the site as well in the winter update section, so you can simply find it there right now, and start having that discussion in terms of what the market is really doing, especially because this time around a lot of damage has already happened in stocks. The real question is, will that damage continue? However, in the very, very short term, when you write such a post after 4 weeks of fall, it finds much more attention simply because the sentiment has already turned negative. That said, we are at an oversold state, and so if you're really looking at taking action, I would think that I would actually wait for the markets to pull back from this extremely oversold condition, and only then consider fresh action as far as the sell side is concerned, because that's what we were doing this week, actually pulling out of many of our shorts and looking at building them up again only later. At the same time, the only sector that I continued to, or rather we got back into on the sell side, was the metals, and that sector did sell off sharply on Friday. Uh, I'm not sure, it may have been the news that the India-US talks on tariffs actually fell apart, because there wasn't any significant move on the metal side that day itself, even though the dollar was up. And in fact, the late session, what we saw is commodity prices actually recovered, especially gold and silver going to a further new high on a 6-day basis. So just a day back, they were selling off as if they didn't want to get past those 40-day averages, and then the following day, you've seen some of them move up. In fact, oil has continued to hold out its gains, which really brings me back to whether the dollar view itself is right, because the dollar had a rally which lasted all the way into almost 2 months back. I think it stopped going up. But for most of this year, starting from January, the dollar was moving higher, initially forming a triangle into March, and then it had its strongest part of the rally where the rub-off was more on the EMs and the EM currencies, and that had a rub-off on most of the EM equities except the Indian market. Now, having seen all that, now that the dollar is actually correcting, you'd like to see a pause. You've seen a pause in most of the EM currency pairs. The USD BRL itself has pulled back to slightly below the 40-day average, but the rupee, the USDINR has actually not even fallen below the 20-day average. So I think there's room there for that to happen at some point. Also, whether the dollar index itself is ready to take off into another move, because I do think that the entire move we've seen this year, even though it's 8-9 months, is counter trend. Either that counter trend is over, or there's at least one more dollar leg left, which is what a lot of the research international community is still anticipating for some reason. And it is a technical possibility that once you pull back a bit, maybe this rise was A, you pull back in B, which is what you're doing, and then you get a larger wave C up before the bear market and the dollar resumes. However, the question is B down over? This week we actually moved up from the weekly bands, and it was a good support level for it to happen. But the problem I'm having is that the momentum indicators from daily, weekly, monthly, quarterly are differing on each time frame, which means you have the daily, which is moved positive, the weekly, which is still negative, not completed its cycles, the monthly, which is positive, the quarterly, which is negative. And if each time frame is differing, when you're purely looking at momentum indicators, then the dollar is giving differing views, and therefore you're not able to come to a conclusive view in terms of what the commodities themselves are doing. But so far, the CRB index has given an indication that the entire advance was corrective in nature and it should roll over. But oil prices continue to hold on, and you have gold and silver, which have the highest short position, which leaves open the potential for a short squeeze that can cause markets to actually, for those markets to actually push up. And so then you wonder whether it will deviate from the dollar or not. So that's what happened, and we are now in a situation closely watching what the dollar is doing, because a clear view on the dollar would really give you a clear view on most of the other asset classes and their interactions. Right now it remains in flux, and so you'll have to look at each one individually on their own merit. And among the things that was happening, that even though the Indian currency and bond markets were weakening, the Nifty continued to head higher against most of the EM space to new highs till the end of August for almost 2 months, and has turned down this month, very similar to what it did in December and Jan, up for 2 months and then sold off. And in doing that, the question is, now that this sell-off has set up, what will our market do? Will do its own thing, probably not align with what the other markets are doing. For example, I've been writing about the risk of US equity, and so far what we are seeing for US equity is, so the net conclusion is that we should continue to look at each market on its own momentum and patterns that are developing. In the very short term, what I see is the potential for the US market to continue to attempt pushing over if the bond market reverses, because the US bond market actually closed positive after several weeks, which means its move down is probably complete, which is what I've been anticipating. And if the move up starts, then you have inverse relationship between US equities and bonds, and that usually a bond rally usually causes a risk off trade, at least in the short term. But at the same time, we are really not seeing much pace, even though the Dow made new highs. You haven't seen a new high in the Russell recently, or the Nasdaq, but at the same time, they're not really falling very sharply. So you actually started to get a revival in some of the Asian markets, especially Hong Kong, Singapore, etc., which were actually down prior to all the trade war news, which was building up throughout September. And so they're actually rallying out of those oversold conditions, which is somewhat a positive environment in the backdrop. And while we've sold off because we didn't fall earlier, so you see each of these markets doing different things in the short term. At some point, they might all align, probably when the next risk of trade gains momentum. But till that point of time, you're likely to see these variations continue. And my sense is, like I said, we are in an oversold condition for our own market. The RSI is down to almost 15 for the small cap index, in the 20s for the bank index, and many stocks, at the double or single digit levels. That the last few days essentially show that, at some point the selling exhausts and you get a pullback is what makes sense. If you're really thinking of the sell side, initiating something here, to me at least, doesn't make sense, which is why I said we are actually been pulling back a bit, significantly, in fact, in the short term, and we'll look for a bounce back or a retracement before we really do anything again. And I think a lot of the selling that you saw on Friday, which was post expiration, can simply be equated with what often happens after a down month in the F&O market, is after the last day is done, a lot of margin calls go out to individual traders who hold back payments for the time period, and or have other funding sources. But once the period completes, then they have to actually make their payments, and then a lot of their stocks in DPs get put up for sales. And that may be one of the reasons why that selling came in on Friday, because that's why the small cap index almost fell 5% that day. Most of the selling was in individual stocks rather than on the front line. And once that is done is when you actually try to take a view on what the market is doing, which is why finding reason for it was probably difficult on that day itself. So that's my take on what's going on right now. I think I should publish another, as this month is done, another long short report with a lot more detail on many of the aspects that I was speaking out. I hope to do it next week. I don't know whether in the early part or later part of the week, but at some point, once everything starts looking interesting again. But it's always interesting, I guess. So what I'll try to also do is update on the economic cycles, longer term data that I think last published it in Feb of 2016. And that probably requires an update because it's been a pretty long time. But then economic data, longer term things like debt to GDP, credit ratios and all don't really change on an active basis. Many data points are not also so well available, but I think that's what I'm likely to try and do. But the market report should be out next week, so that I think is something to look forward to. So in the very, very short term, I think one of the trades that we are trying to put in place, and let's see if it works out over the next week, is the short metals and long FMCG, because that sector appears to have 5-wave declines in some stocks, and we think that's there's a potential for a retracement pullback there. On the other hand, the metals just started selling off in the last 2 days of the week, and maybe they are likely to be weaker compared to the other stocks, is what I was beginning to think and anticipate. So let's see how that goes. That's all in this update. Thank you.